You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Presented by NYFI.
Hi, everyone. You're listening to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is Lars Jensen. Lars, how are you doing?
I am doing absolutely great. As you can see, I am still in my home office in Denmark, and at least on the day here where we are recording it, it's my birthday.
Oh, happy birthday.
Thank you.
That's awesome. Well, thanks for joining us today, despite it being your birthday. But, where else would you rather be than recording a Supply Chain Secrets podcast episode?
That is, of course, true. At least for my birthday, I'm usually not home at all.
Oh, yeah, I can imagine.
This is a special event.
You probably have a lot of airline miles that you can spend on somewhere nice. Awesome. Well, let's get started talking about rates. What is the latest there?
Well, if we start off from the rate developments on the loaded rates, let's look at Asia North Europe first. We haven't touched on that one based on the loaded spot rates from the NYFI index. But now that's actually possible. NYFI has launched yet another index as part of the loaded spot rates. So this also covers cargo that has actually been loaded and booked on spot. And if we look at the Asia North Europe rates, they continued upward slightly this week. The index, when it was launched, has data retroactively back to the beginning of 2025. And what we're seeing here is an upward streak since mid-October. Mid-October was basically a, let's call it, temporary bottom, and then rates have been going up ever since. I know we're going to talk demand development a little bit later, but that's actually the reason why rates were super low on Asia North Europe a couple of months ago, at least one of the reasons. But Asia North Europe continues to strengthen based on actual loaded rates. Not so much if we look over on the Pacific side. On the Pacific, we're now in the third week of decline again. And as usual, there's a bit of variation depending on which of the subtrades we're looking at on the Pacific. But this time around, it's especially Northeast Asia to US West Coast that are incredibly weak. We saw a 15% decline in spot rates for 40-foot containers. And this is basically out of South Korea and Japan. So not a very positive development there, to be blunt. Another trade that has been covered for a while, we have just tended not to talk very much about it, is the Atlantic, where we also have NYFI loaded spot rates. And here we have seen an incredibly interesting development on the Atlantic eastbound. Now, eastbound, keep in mind, these are North American, or rather US exports predominantly, to Europe. And what we have seen there is a somewhat extraordinary development, especially for the 40-foot rates. If we look at the 40-foot rates, they declined sharply this week. So we're now down at less than $700 for a 40-footer eastbound. But where this becomes really interesting is if we look at the 20-footer. As we all probably are very well aware of, a 20-footer is half the size of a 40-foot. So usually the 20-foot rate is also lower than the 40-foot rate. The Atlantic eastbound this week for spot rates for actual loaded cargo, that's not the case. 20-foot containers paid $936. So that means shippers that move 20-foot containers this week on spot actually paid more than $200 more than people shipping cargo in containers that were twice as large. This is quite a distortion of normal market behavior, unlikely to last very long. But this works into also what we've been talking about now for quite a number of weeks, that there is a volatile, almost jittery element to spot rate developments in the market right now. U.S. trade uncertainties playing into it, increasingly rumors of potential opening of the Red Sea playing into it, so everything is jittery. It's hard to get arms around. And is also, at least what I'm picking up in the market, making it difficult for some of the usual year-end negotiations in terms of annual contracts, at least the ones that follow the calendar year. What should we expect from a 2026? And I fail to see any stable environment also for freight rates in 2026. That's, of course, at least from my perspective, an indication that index-linked contracts might be the way to go. And of course, also, as we've been discussing before, and as was announced by NYFI at their event in London back in November, there will be derivatives coming for those that are interested in trying to smooth out the roller coaster rides of rates that we are heading into here in 2026. And yes, this was what did we see for actual loaded rates? So these rates are being paid for shippers that actually booked on spot and actually had their containers on ships. If we then just briefly look at the SCFI, which are then quoted rates, which is more measuring, let's say, market sentiment. Pacific rates continue to decline out of China, and this time at about $100 per F down compared to last week. We are seeing Asia, North Europe more or less flatlining, a little bit up on the Mediterranean. So the SCFI sort of, again, slightly jittery, but not really much direction apart on the Pacific, which tends to be going down.
Awesome. Thank you for that. It seems like we've got some interesting developments, especially when you're looking at the 2040 split for TA Eastbound. It's kind of interesting to see since you don't typically expect your 20-foots to be more expensive. Yeah, overall, It seems like our rates are not really super settled at this point. But what does demand look like? Like, how is that playing into how the rates are developing?
Yeah, good question. And we got the new data from Container Trade Statistics here just before the weekend, and it's weakening. If you look at it from a global perspective, global demand is down. Global demand is down 2.1. We still grew 2.1%. Sorry for the confusion here. The reason I mistakenly used the word down is that for all of 2025 until now, we've actually seen growth rates around 4.5%. So the global growth rate we see now, still 2.1%, is decent growth rate, but it's half of what we have seen so far. And that, of course, brings up the question in terms of why. Why did we see a decline in growth rate so suddenly? It's not U.S., because U.S. is definitely performing weak. We still have negative U.S. import growth from every region around the world. Courtesy of the U.S. trade war, this is not really different from the pattern we have seen ever since April when the trade war began in earnest. The real culprit, so to speak, of this drop is the Asia to Europe trade. It's not European imports, because imports into Europe from North America, South America, Indian subcontinent, Middle East, they are growing ballbusters. It's going great. But specifically Asia to Europe, which has been growing around 10% year on year for most of this year, suddenly dropped in and showed a 3% decline in volume in October. Right now, I'm not sure I have a very good, solid explanation for it. I don't see data that supports a solid interpretation. A hypothesis would be that the part of the strong growth we've seen for the first 9 months was front-loading of a lot of cargo. It could be some of the Chinese cargo they couldn't sell in the US that was then also launched into the European market, which means that the high growth rates at some point was destined to come to an end. But it cannot be overall European weakness as a result, because then we wouldn't see the very strong growth rates from Indian subcontinent and both Americas. But this drop on Asia-Europe, as severe as it was actually enough to cause a very significant decline also in demand. And that's if we measure demand in TEU. Even more interestingly, if we measure global demand in TEU miles, the impact is even larger, because the Asia-Europe trade is one of the longest trades that we have. So a setback in demand there also pulls down TEU miles. If we measure demand in TEU miles, it's a growth at an anemic 0.1. So basically, global demand growth stopped. And back to what I also mentioned, this bottom that we saw in loaded spot rates on Asia-Europe was in October. That seems to coincide with a sudden weakness in the demand picture that could also explain why Asia-Europe rates declined to that bottom at that point in time. But that's Asia-Europe. We have solid growth in other places around the world. A couple of the strongest growing import regions, Africa in October, global container volumes were up 10% year on year. Indian subcontinent, Middle East, they're up 7% year on year. So it's not a widespread weakness in the market, as I mentioned. This is the continuing U.S. trade war effect, and suddenly also Asia-Europe. Most other major key trades are doing just fine.
And now you're seeing kind of a shift in the balance of how things are moving around the world, with America, Europe declining in imports. Super interesting. Is there any tariff news to consider when you're thinking about how the demand is shifting and what to expect moving forward?
You can say yes and no. The positive news is this is now the second consecutive week where you can say there has been no changes to tariff rules in the U.S., which again is positive news, absolutely. However, there is one piece of news that could potentially become important in this context. It's not new tariffs, but it's an investigation that's been launched by executive order in the U.S. looking into food supply chains. The whole premise of the executive order is that there appears to be some concern what is labeled as foreign corporations might be, conspiring would be the wrong word, but is more or less in charge of part of the markets, making food more expensive for American importers than it otherwise would have. Whether that is true or not, I will not be the judge of. That's also why they do the investigation. But as we have seen at times with these investigations, they tend to lead to actions down the line. And if that is the case and there are any kind of restrictions on foods, I would just put a number out there and say if we dig in at the bill of lading level, I was using data from a company called Cargofax where you can drill into that. What we saw there is about 5 million TEU per year is imported into the US. That's actually foodstuffs. So changes in possible rules on imports of foodstuffs going forward can actually have a sizable impact on the volumes. And just in case anybody's curious, what is the largest food commodity that's being bought in the US that's not produced there? Bananas. More than 500,000 TEU of bananas is being imported per year into the US.
Is that mostly South America?
That would be my assumption. Good question. It's an assumption. I haven't looked into the country distribution, but that would be I would be surprised if that's not where the bulk of them come from.
Yeah, interesting. And if our audience remembers, we've talked about it in a couple of episodes over the last month, but a lot of the tariffs on food items have gone away. So it's kind of interesting to see this come about so shortly after.
Yeah, we are not supposed to have a political podcast here, but to me this seems more like a political issue rather than a trade issue. I mean, domestic U.S. political issue.
Yeah, political issue with maybe some trade impact. All right, well, maybe continuing on the vein of politics just slightly. So there was a ceasefire in Thailand and Cambodia that was compromised recently. So can you talk a little bit about that?
Yeah, we covered it quite a number of months back. The challenge was that suddenly there was hostilities / low-key border war that erupted between Thailand and Cambodia. Why this is important for the supply chain is that you have a lot of Cambodian imports and exports that were moved overland, especially to Lam Chabang, the large port in Thailand. But because of the border dispute, the border closed, forcing quite a rearrangement of some of the supply chains, especially related to Cambodia. Then a bit over a month ago, there was a ceasefire agreed between Thailand and Cambodia. This morning, I should say, we are recording this Monday, December 8th, this Monday morning. There was an aerial attack by the Thai Air Force on positions in Cambodia. The reason for that is disputed. Thailand claims that there were attacks by Cambodia. Cambodia denies any involvement. What is actually true or not true? I don't know. We just know that there have been an escalation again in hostilities despite the ceasefire. So anybody with supply chains critical, especially to Cambodia, should not necessarily expect any normalization of those supply chains anytime soon.
Is there any impact on carriers that, have multiple ports of load in that region where they're going from Cambodia to Thailand?
Not necessarily to my knowledge. It's the land border that is closed. We should also remember there are not really any of the major deep-sea trades that call Cambodia. The port is not geared for that. So it would be feeder vessels. And feeder vessels, as I understand it, are still operating more or less per normal, not just over to Thailand, but what's equally important that they are operating up to Vietnam, operating down to Tanjung Pilar Pass in Malaysia, down to Singapore.
Awesome. All right. Well, thank you for that update. And the last thing we have on the agenda today is a vessel attack. Can you talk a little bit about that?
Yeah, it's one of these where it sounds more sinister than it is. If you just hear the headline, there was a vessel attack in the el-Mandeb Strait. Everybody immediately think, oh, this is the Houthis that are going to be added again. But the interesting thing was this was a bulk vessel that was approached by a number of small skiffs. There was then small arms fire exchange between the skiffs and armed guards on board the ship. The attack was repelled. This does not look like any attack the Houthis would usually do. On the other hand, it looks very much like some of the opportunistic piracy attacks that we at times see coming out of Somalia. And the Houthis haven't claimed responsibility either. They're usually very happy to claim responsibility. For them, it's a win, it's a victory. That's their perspective. Right. So it really looks like, yes, it was an attack in the risk area in the el-Mandeb Strait, but it does not look like this was actually the Houthis. And the reason why this is important is, of course, there's increased hype whether or not the Red Sea routing is going to be reopening anytime soon. I don't think this attack should be seen as a sign that, oh my God, now everybody's going to pull back. What I would mention out there is, again, we're going to get this massive turmoil. If the carriers have any choice in the matter, operationally, they should shift back after Chinese New Year, because this is where the volumes are the lowest. This is where you will have the least disruptive impact up in Europe. They might not necessarily have a choice whether to do it exactly there, but I'm just saying from an operational perspective, second half of February coming into early March would be the most ideal time over the entire calendar year in which to actually do it. Then it becomes fun to look a little bit at the numbers. Because if we all think back a couple of years, when carriers first started to go around Africa, we also started measuring demand in TEU miles. And because of the vast extension of the sailing distance, global demand suddenly grew around 25 to 30%, which of course absorbed a lot of capacity. Now we can do the opposite calculation. I mean, let's just look at what if. Purely what if we go back everybody through Suez tomorrow. Let's just forget all the port congestion for a second. What will that do to demand in TEU miles? Obviously, it's not going to decline because we're shortening sailing distances, but by how much? Depending on whether we take third quarter 2025 as baseline or the newest data in October as a baseline, you're going to see global demand in TEU miles decline somewhere between 12 and 17%. This is, of course, a massive expansion then of available capacity out in the market. But let's also keep in mind, sure, we are reducing demand 12 to 17%, but back when the crisis started, we actually increased demand 25, 30%. Underlying demand in TEU has grown since, so the huge step we see down in demand now is still to a demand level that is considerably higher than where we were in 2023 before the crisis broke out.
That's interesting. And maybe a little surprising, too, that the demand is still higher than where we were at a couple of years ago. But that's pretty consistent, right? Like year over year, you tend to see demand grow.
Yes. Yeah. From a marketing perspective, I can understand it. Most ports, at least most successful ports around the world, will at multiple times every year have some sort of press release saying, we have a new record in port handling. Yeah, of course you do. Global trade is growing. Global trade has been growing for 80 years. So unless something goes horribly wrong, you have a lot of locations, a lot of carriers, a lot of ports that, of course, set new records year after year. That's in the nature of a growing trade environment.
Yeah, well, it's a good thing to keep in mind, in looking through marketing updates and stuff from ports. But it's definitely a good update. We get a lot of bad news often, so I would take that over the bad news for sure. All right. Anything else you want to add today?
No, I think we covered all the important topics that were here now.
Awesome. Alrighty. Well, I will let you go, Lars. You can enjoy your birthday. And if you all are listening today on Monday, be sure to send him a message on LinkedIn. I'm sure you'd love to hear from everyone a nice birthday wish. But until next week, please subscribe if you haven't already. And we'll be back next Monday. Have a good one, y'all.
Thanks for listening to Supply Chain Secrets Podcast, presented by NYFI. Be sure to subscribe on your favorite podcast app. Want to be a part of the show? Register to attend a live recording at the link below.